They didn't correct silver, they crushed it. 50%. Erased, just like that. 1 minute Americans were celebrating inflation protection, and the next minute they were staring at red screens, margin calls, and financial media smirking about dumb money. But here's what they won't say on CNBC. While retail investors were panic selling, while social media went silent, while headlines declared silver dead, someone was loading up, quietly, systematically. And now, silver is back, not at $30, not at $50, some $85. So here's the question nobody in Washington wants you asking. Was that crash a coincidence? Or was it a controlled demolition of Main Street wealth? Let's talk about it. Let's rewind. America was on edge. Inflation was eating paychecks alive. Groceries were up. Rent was up. Gas was up. Insurance was up. Everything was up, except real wages. The Federal Reserve said inflation was transitory. It wasn't. Americans felt it every single day. So people did what history has always taught them to do during monetary instability. They bought hard assets. Gold moved. But silver? Silver exploded. Why? Because silver is the people's metal. It's affordable, accessible, historically explosive, and when confidence in the dollar starts cracking, silver becomes a pressure valve. Social media lit up. Coin shops across the country reported shortages. Online dealers showed delays. Premiums over spots surged. Americans weren't speculating. They were protecting themselves. And for a moment, it looked like Main Street was ahead of Wall Street. That's when things got dangerous, because when retail momentum starts threatening institutional positioning, the rules change. Then came the sell-off. Not normal selling, not healthy profit-taking. We're talking about massive futures dumps in low liquidity hours, thousands of contracts hitting the market at once, enough to shock price violently downward. And when price drops fast enough, it triggers stops. Forced selling begins, margin calls activate, leverage unwinds. Retail investors don't get time to think. They get liquidated. Silver didn't drift down, it collapsed. 50%, half, gone. Billions in retail wealth evaporated in weeks. Financial media responded almost instantly. Speculative bubble bursts. Commodity trade overheated. Retail mania ends. Notice how fast the narrative forms when retail loses? Now here's the uncomfortable part. During the crash, physical demand didn't disappear. Coin premiums stayed elevated. Dealers still reported buying interest. So how does price collapse if demand stays? Because silver's price isn't set by coin shops. It's set in the paper futures market. COMEX, highly leveraged, institution dominated. For every ounce of physical silver, there are multiple paper claims. When institutions flood the market with synthetic supply, price reacts, regardless of real-world scarcity. Is that illegal? No. Is it manipulative? That depends on who you ask. But here's what's undeniable. The crash eliminated retail positioning. The crash reduced speculative pressure. The crash allowed accumulation at cheaper prices. And history shows something chilling. Every time silver builds strong retail momentum, it gets smashed. And now, coincidence? Maybe. But patterns matter. The truth is, markets are not purely democratic. They are hierarchical. Capital concentration matters. Speed matters. Access matters. Institutions trade on information, leverage, and scale retail investors don't have. So when volatility spikes, guess who gets squeezed first? Main Street. And guess who survives? The players with deeper pockets. But here's where it gets interesting. Because while the public narrative declared silver dead, the macro reality was getting worse. Debt kept rising. The dollar kept losing purchasing power. Geopolitical tensions increased. Industrial demand projections strengthened. The crash didn't fix the fundamentals. It only reset sentiment. And sentiment is the easiest thing to manipulate. Fear spreads faster than logic. And during that 50% collapse, fear was everywhere. YouTube channels went silent. Comment sections turned toxic. Retail traders swore off metals forever, which is exactly what shakeouts are designed to do. Exhaust participants, demoralize believers, clear the field. And when the last weak hand finally sells, that's when the bottom forms. The question isn't whether silver crashed. It did. The real question is, who was buying while America panicked? Because someone always is. And what happened next suggests this wasn't the end, it was the setup. After the crash, something strange happened. Silence. No more viral silver videos. No more headlines screaming about shortages. No more influencers predicting $100. Just quiet. And that's when the real story started. Because markets are loud at the top and silent at the bottom. While retail investors licked their wounds, something very different was happening behind the scenes. Price stopped falling. It didn't rebound dramatically, it stabilized. And stabilization after a violent liquidation event is not weakness, it's absorption. The panic sellers were gone. The leverage was flushed. The emotional traders were out. Now the only participants left, patient capital. Let's talk fundamentals, because this is where the narrative falls apart. During the 50% collapse, did inflation disappear? No. Did U.S. national debt shrink? No. Did the Federal Reserve suddenly restore long-term purchasing power to the dollar? Absolutely not. In fact, the structural problems intensified. Interest payments on U.S. debt were rising fast. Federal deficits continued expanding. Global conversations about de-dollarization were increasing, and meanwhile, industrial demand for silver kept growing. This is the part almost nobody on financial television wanted to emphasize. Silver is not just a precious metal, it's strategic. Solar panels require it, electric vehicles require it, advanced electronics require it, military systems require it, artificial intelligence infrastructure requires it. America's green energy transition, silver intensive. Global electrification, silver intensive. Now here's the uncomfortable math. Most silver isn't mined as silver. It's mined as a byproduct of copper, zinc, and lead. If base metal mining slows, silver supply tightens automatically. You can't just flip a switch and increase silver production. New mines take years, sometimes decades, to develop. So while price was crashing, supply wasn't exploding, demand wasn't collapsing, and deficits in the silver market continued quietly in the background. Let that sink in. A structural deficit commodity dropped 50%. That's not fundamentals, that's positioning. And positioning resets create opportunity. During this boring phase, institutional flows began shifting. Commodity funds slowly increased exposure. Silver ETFs began seeing inflows again. Not explosive, steady, measured. Strategic, no hype, just accumulation. This is how professionals move. They don't chase green candles. They buy when nobody's looking. They buy when sentiment is broken. They buy when YouTube views collapse. They buy when retail swears never again. And technically, something critical was forming. Higher lows, stronger support levels, reduced volatility on pullbacks. That's not random. That's compression, like a spring being tightened. Meanwhile, macro pressure was building. Bond markets showed instability. Real yields started losing momentum. The dollar stopped strengthening. And here's the golden rule of metals. When real yields soften, silver wakes up. Because silver doesn't compete with bonds when rates are attractive. It competes when confidence in fixed income starts cracking. And that's exactly what began happening. The Federal Reserve found itself cornered. Keep rates high, risk recession and debt stress. Cut rates, risk inflation resurgence. Markets started pricing and eventual easing. Liquidity expectations shifted, and silver started climbing. Slowly at first, almost unnoticed, then steadily, then decisively. Short sellers who believed the crash meant long-term weakness started feeling pressure. Because when a market refuses to make new lows, it's telling you something. And when silver broke its first major resistance level post-crash, volume expanded, momentum traders returned, algorithms flipped. This wasn't retail hype, this was structural reallocation. And here's the irony. The same crash that destroyed confidence created the fuel for the rebound, because all the weak hands were gone. Now silver wasn't climbing on hope, it was climbing on positioning. And once momentum builds in silver, it doesn't crawl, it accelerates. The silent phase was over. The spring had been compressed long enough, and when it finally released, it moved fast enough to shock the very people who thought silver was finished. But the next phase, that's where things got explosive. Because breaking resistance is one thing. Breaking history, that changes everything. For more than a decade, one number haunted the silver market, $50. That was the high watermark. Every rally since then had failed beneath it. Every breakout attempt was rejected. Every surge eventually faded. $50 wasn't just resistance, it was psychological trauma. So when silver began approaching that level again, after the 50% crash recovery, nobody quite believed it. Not retail, not media, not even many institutional desks. The narrative was cautious. Probably another fake breakout. Metals always disappoint. Too much overhead supply. But price doesn't care about narratives, it cares about pressure. And pressure had been building for months. Higher lows, stronger volume, shallower pullbacks, rising open interest. This wasn't emotional buying. This was structural positioning. Then it happened. Silver punched through $50. Clean, decisive, no hesitation. And in that moment, something snapped in the market's psychology. Because breaking a long-term high isn't just technical, it's symbolic. It signals regime change. Algorithms that were programmed to sell near $50 flipped to buy. Trend-following funds that had been waiting for confirmation entered aggressively. Short sellers who had leaned heavily on that historical ceiling were suddenly trapped. And when short sellers are trapped, they must buy to exit. Buying creates upward pressure. Upward pressure triggers more buying. And that's how squeezes begin. Within weeks, silver surged to $60. Financial media couldn't ignore it anymore. The same outlets that mocked the rally months earlier now invited commodity analysts back on air. Is silver entering a new bull market? Is this the start of a commodity supercycle? Retail interest returned, but this time with hesitation. Many who sold during the crash watched in disbelief. Regret is a powerful force in markets. Investors who panic sold at $25 were now staring at $60, and regret often transforms into aggressive re-entry. FOMO ignited. Coin dealers across America saw traffic spike again. Online bullion retailers reported surges in orders, premiums widened, physical supply tightened. At the same time, macro forces aligned. The dollar softened as rate cut expectations grew louder. Real yields compressed. Debt concerns resurfaced in headlines. Geopolitical tensions escalated globally. Silver, uniquely positioned between monetary metal and industrial necessity, absorbed capital from multiple directions at once. Inflation hedgers bought. Industrial growth believers bought. Momentum traders bought. Speculators bought. And here's the critical factor. There wasn't enough immediate supply elasticity to absorb that surge cleanly. Remember, silver isn't mined on demand. Production is slow-moving. Deficits had been accumulating quietly for years. So when demand accelerates quickly, price must do the adjusting. That's exactly what happened. $60 turned into $70 faster than analysts predicted. Pullbacks were shallow, aggressively bought. Each dip reinforced confidence. Each breakout triggered more systematic buying. Institutional money managers who had been underweight commodities began rebalancing portfolios. Why? Because silver at $70 wasn't just a trade anymore, it was a macro statement, a signal that the market was repricing monetary stability. Then came $80. At that point, disbelief turned into urgency. Pension funds increased exposure, hedge funds expanded positions, options markets showed heavy call activity. Volatility expanded on a hot but upward. And when silver touched $85, the shock was complete. From a 50% collapse to a historic breakout. From dead asset to macro centerpiece. The speed of the move was unsettling. Because violent rallies, like violent crashes, expose fragility. And this rally exposed something deeper. It exposed how quickly confidence can shift in the U.S. financial system. Silver doesn't rally this aggressively in stable, calm environments. It rallies when trust erodes, when debt becomes unsustainable, when currency purchasing power feels uncertain, when investors begin questioning long-term policy credibility. Was the move purely organic? It was driven by real forces, but was it amplified by leverage, options flow, and short covering? Absolutely. Silver's volatility cuts both ways. The same mechanics that crushed it 50% on the way down launched it vertically on the way up. And now the question isn't, how did it get here? The question is, what does $85 actually mean? Because markets don't make moves like this in isolation. They're reflecting something bigger. And that brings us to the final uncomfortable conversation. Is $85 the destination? Or is it a warning? Let's finish this. Silver at $85 is not just a price. It's a message. And messages like this don't appear in stable monetary systems. Let's be clear about something. Commodities do not move 200% off their lows for no reason. They don't double after a 50% crash because investors got excited. They move like this when something underneath the financial system shifts. Silver is volatile, yes, but it is also historically sensitive to three things. Currency confidence, real interest rates, systemic stress. When those pressures build quietly for years and then ignite all at once, you get a move like this. Now ask yourself, has U.S. debt decreased? No. Has long-term purchasing power of the dollar stabilized? Not convincingly. Has geopolitical stability improved? If anything, uncertainty has grown. America is carrying historic levels of debt. Interest payments alone are consuming massive portions of the federal budget. Entitlement obligations loom. Defense spending remains elevated. Infrastructure, energy transition, healthcare, all capital intensive. At the same time, political division has deepened. Global powers are discussing alternatives to dollar dominance. Central banks around the world continue accumulating gold at record levels. Why? Because gold, and by extension silver, are neutral reserve assets. They carry no counterparty risk. They don't depend on policy credibility. They don't require trust and fiscal discipline. And when trust becomes fragile, metals become attractive. Silver at $85 suggests the market is demanding a higher risk premium for holding paper currency. That doesn't mean collapse. It means repricing. There's a difference. But repricing can be just as disruptive. Because when assets reprice quickly, capital shifts quickly. And rapid capital shifts create instability. Here's what makes this moment controversial. Some argue silver is simply experiencing a speculative mania. Others argue it's the early phase of a structural commodity supercycle. Let's examine both. If this is speculative excess, then we should expect parabolic blow-off behavior, massive retail FOMO, unsustainable leverage, sharp correction. And yes, some of those signs exist. Options. Activity is elevated. Retail search trends are rising. Momentum traders are aggressive. That raises caution flags. But here's the other side. Industrial demand for silver continues growing. Green energy infrastructure isn't slowing down. Electrification isn't reversing. Technology isn't reducing its reliance on conductive metals. Supply growth remains constrained, and fiscal pressures in the United States are not easing. That supports a structural bull thesis. Now here's the uncomfortable middle ground. Both can be true. We can be in the early phase of a long-term structural uptrend and still experience violent pullbacks. Silver doesn't move in straight lines. It punishes complacency. The 50% crash proved that. The rally to $85 proved something else. Underestimating silver can be just as costly as overleveraging it. But beyond price action, there's a bigger psychological shift happening in America. Trust is changing. You see it in alternative asset adoption. You see it in growing interest in commodities. You see it in rising concern about debt sustainability. You see it in younger generations questioning traditional financial pathways. Silver's move reflects more than profit-seeking. It reflects hedging behavior. When people feel secure, they chase growth. When they feel uncertain, they hedge risk. Silver at $85 suggests hedging demand has strengthened significantly. Now comes the critical question: what happens next? There are three possible roads. First, consolidation. Silver cools off, pulls back, builds support between $70 and $85, establishes a base before another leg higher. Second, violent correction. Momentum fades, overleveraged positions unwind. Price retraces sharply, perhaps 20-30%, shaking out late buyers. Third, structural expansion. Macro conditions continue deteriorating. Rate cuts weaken the dollar. Industrial demand accelerates. Silver enters a multi-year uptrend that rewrites historic highs. Which path unfolds depends on policy. It depends on inflation. It depends on debt management. It depends on global trust in U.S. financial leadership. But here's what is undeniable. The era of complacency is over. The illusion of permanent stability has cracks. Silver didn't just come back. It forced a conversation about currency, about debt, about leverage, about systemic risk. And here's the most controversial part of all. If silver can crash 50% in a matter of weeks and then rally to $85, what does that say about the fragility of modern markets? Extreme downside, extreme upside. That's not stability, that's tension. And tension doesn't disappear. It resolves one way or another. So no, $85 isn't the end of the story. It's the signal flare. The market is telling you something. The question is whether investors are listening. Because in volatile times, wealth isn't built by reacting emotionally. It's built by understanding cycles. The crash was fear. The rally was repricing. What comes next? That depends on whether this was a temporary shock or the beginning of a new monetary chapter. Either way, one thing is clear: silver is no longer ignored. And when a forgotten asset becomes a focal point of global capital, history tends to follow.